Looking around for stocks to research, I came across a company that's not only popular for its golden fries, but also for its dividends. I noticed this company trades at a really high valuation too, and it got me wondering, does McDonald's deserve to trade at such high multiples? And is it even worth investing in? Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. And yes, you did hear me right, today we're talking about McDonald's. But before we get into what those golden arches are up to, let's lay some groundwork. Brothers Richard and Maurice McDonald started their business in 1937 with the extremely catchy name The Airdrome. Soon the brothers realized that they made a solid chunk of profit from selling just a few food items. They closed up shop, moved elsewhere, and then opened a new restaurant named McDonald's, focused on this limited, hyper-profitable menu. By 1954, the McDonald's expanded to 6 franchise locations. Then Ray Kroc entered the picture. He believed that the concept of franchising would be extremely lucrative, and he offered to take over this aspect of the company. Throughout the 60s and 70s, McDonald's continued to expand rapidly, tremendously helped by the relatively new interstate highway system. Yet the company expanded beyond American borders, opening locations across the world in the 80s and 90s. Nowadays, McDonald's employs over 210,000 people in 38,000 locations across 120 countries. You probably can't go too far without seeing those golden arches from the highway or on the corner. Now let's see where this fast food giant stands today financially. From the start, I knew this was going to be an interesting ride into the company's financials, so we'll begin with McDonald's declining revenue. In 2015, McDonald's boasted a solid $25.4 billion in revenue, but at the close of 2020, it posted revenue at $19.2 billion. That's the first time since 2006 that the company has posted revenue under $20 billion. Note that this isn't necessarily because of the pandemic either. You can see here that the company's revenue has been consistently falling for 5 years now. I somewhat understand this given McDonald's massive size, but it's still not great to see. Next on our list is shares outstanding, and a bit of a surprise. I never expected McDonald's to buy back shares, especially at the rate it's been doing it. In 2015, it had 939.4 million shares outstanding, but in 2021, McDonald's currently has 744.6 million shares outstanding. Despite the declining revenue, McDonald's is giving shareholders a larger slice of the investing pie. Looking at free cash flow, we have yet another surprise. McDonald's free cash flow has been basically flat over the last 5 years. While the company had $4.73 billion in free cash flow in 2015, McDonald's now has $4.62 billion in free cash flow as of last year. This is only a slight decrease, so nothing really to worry about here. On to current assets versus current liabilities. As expected, the arches have $5.47 billion in current assets against $4.58 billion in liabilities. This comes with a healthy $3 billion in cash. Now let's take an average of the free cash flow over the last 5 years and multiply it by 15 to get an expected market cap. You'll notice I changed the multiple to 15 because I don't believe that multiplying by 20 is a justifiable price of free cash flow to pay for a company losing revenue at the rate McDonald's has. Doing the math with 15 instead, we get an expected market cap of $67.5 billion. Currently, McDonald's market cap is trading at $181 billion, so slightly massively overpriced from a free cash flow perspective. Up next are my two favorite metrics, ROIC and McDonald's famous dividends. I did expect to see a solid return on invested capital from McDonald's, and we do have an average of 11.2%, so just barely over our 10% expectations. Last year's ROIC was 13.71% though, so maybe McDonald's has managed to do something right last year. Finally, let's look at the dividends that McDonald's pays. Starting off, we have a 2.12% dividend yield per share, equating to $1.29 per quarter for a rough total of $5.16 per share per year. The payout ratio stands at 60%, which means that 60% of McDonald's free cash flow goes towards paying these dividends. Normally, I would like to see this around 35 to 40% to give the dividend room to grow. 60%, while high, is still perfectly acceptable though. Plus, McDonald's has been growing its dividend every year for the past 45 years at an average growth rate of 7.78% over the last 5 years. If I'm being honest, McDonald's dividend department is lackluster given the hype. I expected a higher, more stable dividend, though I can see the appeal of a dividend that's solidly above the average market yield. So here's another question. Why is McDonald's revenue going down so drastically, and is there any hope? One of the biggest reasons that McDonald's has seen such a sharp decline is its restructuring plan. There are two types of McDonald's locations, company-owned stores and franchise stores. In 2015, McDonald's announced all-day breakfast and the push to change all of its locations to franchise stores. At the time, only 81% of its stores were franchise franchised, with 19% being company-owned. Now, in 2021, roughly 93% of its stores are franchised, leading to a revenue decline. The total restaurant revenue is no longer recorded, just the fees collected from the franchise stores. Another reason for the decline could be the trend towards healthier eating I mentioned in my last video. Let's face it, no one goes to McDonald's to eat healthy. People go there because they need quick and easy, no-fuss food. In the past, this grab-and-go style of food worked well for McDonald's, but nowadays that way of doing business might not be working so well. True, in recent years, McDonald's has added healthier options to their menu, but I think we can all realistically accept that it's not going anywhere significant. All that said, let's examine some of the positives going for the fast food titan. The first and chief among these is its restructuring plan. It's been both a hit to the company's revenue, but it's also done pretty well, at least according to the company itself. Like I said before, McDonald's has managed to refranchise many of its stores. This led to a dramatic increase in net income despite its falling revenue, as seen here. So perhaps this restructuring plan does have some merit and might continue to foster higher profit margins with a less cash-intensive business focus. Only time will tell, though. Before we move on, I want to mention the Accelerating the Arches program coming from Ronald HQ. From this pretty little infographic, it seems to be very corporate and cold, with large sweeping statements about inclusion and family. In other words, the type of stuff you expect from these massive corporations. Make of it what you will, but I'm disregarding this one in favor of the actual restructuring plan. The last potential tailwind I'll mention is McDonald's large push for upgrading the technology of many of its locations, with acquisitions like voice recognition company Apprente and Dynamic Yield in 2019. McDonald's is implementing more and more of its technology in its restaurants, with self-serve kiosks that change based on time of day, weather, and even traffic in the restaurant. The company's push for technological innovation is certainly apparent. This all sounds great and wonderful, but we need to again look at some of the serious challenges facing McDonald's. First and foremost are competitors. In the ever-changing landscape of fast casual dining, newcomers and old allies are cropping up and outpacing the Arches. Once owned by McDonald's, Chipotle has taken off on its own after McDonald's sold its stake. At that point, the Mexican grilling restaurant chain was only 1/20th of McDonald's size. Now it's 1/3 just 15 years later. A great example of a competitor taking McDonald's market share. Companies like Starbucks and Subway are also eating away at McDonald's market share, chipping away at that gap every year. While I think the competition is the biggest challenge facing the company, there's also significant risk if McDonald's turnaround plan doesn't pan out as well as hoped. Yes, the restructuring plan has worked to a degree, but McDonald's still has yet to post improving revenue since 2015. So there is a very real possibility that this plan could fizzle out with McDonald's. The last challenge facing McDonald's is the food itself that the company serves. More people want to eat healthier, sustainable, and ethically sourced food products. Let's face it, McDonald's has a long-standing reputation for unhealthy, borderline addictive food sourced from unethical farms and slaughterhouses. Now to answer the question posed at the beginning of the video and in the title, does McDonald's deserve to trade at the high multiples it does now? No, I don't believe so. In my opinion, McDonald's isn't doing enough that it deserves to trade at traditionally tech multiples. I would even go so far as to say that a traditional multiple like 20 is too high for the company now. Like I did earlier, I'd rather opt for 15 times free cash flow instead. Really, I do think McDonald's is pushing for innovation, just not nearly as much as it has in the past. The company has a long way to go before deserving of its current crazy valuation. I hope you all enjoyed this video. Be sure to tell me your thoughts on McDonald's in the comments below. Until then, I will see all of you in the next episode of Dollars and Cents.